Our session on demystifying indexed universal life. This is the fourth of a 5-part series, and this one is on effective illustration tips. So let's give you just a little bit of information on ways to make your illustrations a little bit more effective. We're going to talk about the illustrations themselves and some things that you can do on illustrations. A little bit about historical lookbacks, because some people want to get a better understanding or appreciation of where those come from. And then a few ideas on comparing illustrations, because we realize that sometimes you're going to look at maybe another company or a different product and you want to compare illustrations. So I'm going to give you some ideas to be most equitable or fair in comparing illustrations. The first tip is probably my best one. This is the favorite that I have. And this is the idea about considering the amount of insurance and leaving room for premium growth. And let me paint a picture of this here to kind of give you an idea why I'm mentioning this or why I'm listing this as the #1 tip. So many illustrations that I see, probably most of the illustrations that I see on our Builder IUL, for example, are retirement planning type of illustrations where they are funding at a certain level, solving for the minimum face amount, and then solving also for the maximum income that they can get. That's a typical retirement planning type of case. We'll talk about that a little bit in the next session on sales concepts and how to sell. But if you do, what I would suggest is that's fine. You can go ahead and do that, but you need to think a little bit about real life. Because if you're solving always for the minimum face amount and maximum income, what happens if they want to change their premium a little bit? Because that is more typical real life. That's what really happens. How many people fund their retirement goals at the exact same level for 25 years in a row? It just doesn't happen. That's not reasonable. People have changing income levels, they have changing expenses. As you get closer to retirement, your income levels might go up, your expenses might go down a little bit as you start moving children out of the home. And also, as you get closer to retirement, that's a little bit more, right in your face in terms of the need is approaching. And people have a little bit more incentive or motivation toward growing their retirement goal. So the idea that people are going to fund their retirement plans for the exact same amount for 20, 25 years doesn't seem reasonable. Yet, we see all sorts of illustrations where people are assuming that exact thing. So when you specify the same premium for 20 years or 25 years or whatever, what happens if the client wants to come back 2 or 3 or 5 or 10 years from now and raise the premium a little bit? Maybe you started at $400 a month, and after a few years they say, this is working well, I got some raises here, and let's see if we can make that $500 a month. What do? You're gonna have to apologize and say, I'm sorry, but I kind of made an assumption that you weren't ever going to raise that premium, and now we have to go back and we have to go through underwriting to apply for a face amount increase to see if we can allow you to put more money into this policy. That's a challenge. So what I would suggest is leave room for the premium growth. Leave some room for real life. And what that will do is a couple things. That will obviously better perhaps meet their client's needs, but that will also help you, the agent, in getting a little bit better commission opportunity as well. Because instead of the minimum face amount, we're going to raise that face amount up a little bit to leave room for flexibility in premium payments. And with the commissions largely based upon face amount, this is the best and easiest way to get your commissions up a little bit. Now, if you want to do this a little bit more scientifically, you can certainly illustrate this. So on the right-hand side of the screen, I have an example of like a $300 a month, and that's the typical $300 a month. You can do a little increase on a modal type of variance. So you could say, well, what would happen if I increased by 3% per year or 2% per year? Or you can just throw in premium increases. You can just click on and specify increases. Sometimes that's what I do. I might start at $400 a month, and then after 5 years, I'll just arbitrarily pick a number. Let's say $500 a month. And then after another 5 years, I'll go to $700 a month. And then after another 5 years, maybe $900 a month as they get closer to retirement, or $1,000 a month. What that's going to do is it's going to give you an illustration that's really compelling. It's a powerful sales illustration because you're not asking for any additional dollars today, but you're getting an illustration that generates a much larger income stream in retirement. So instead of just doing $300 a month every year, let's do 300 and then 4, 5, 7, 800, gradually increasing that premium amount. And if you look at the retirement income that these two illustrations can generate, the difference is dramatic. It's so much better. And it's probably more reasonable in real life situation that this is more likely what they're going to do as they approach retirement as opposed to a level premium payment. And as the agent, you're going to see the commissions probably double because your face amount is that much larger. Now, one of the challenges that I get from people when I discuss this idea sometimes is they say, well, what happens if they don't increase their premium? Then I just got a face amount that's too big. Well, okay, that's true. But you can always reduce the face amount. You don't have to go through underwriting to reduce the face amount. So maybe you hold on to it for 10, 15 years, wait for a little while. You don't have to reduce the face amount right away in year 4. The cost of insurance charges are not really large for a 45, 55-year-old. Cost of insurance charges become more significant when you get to 65, 70, 80, those ages. So it does not cost a lot of additional charges to have a lot more flexibility for your client. And the other tip I would have on this is maybe just the idea of show both. Just run 2 illustrations. How much extra time does it take to run 2 illustrations instead of 1? So you run 1 illustration that you would have run. Maybe that's the level premium, $300 a month from, in this example, I guess we got 35-year-old, 35 to 65. Run that $300 a month for 30 years and then show the income stream. And then run another illustration saying, and if you put a little bit of premium increases in here, maybe it's a percentage, maybe it's just the random dollar amount, here's a type of income stream that you could get. And they'll see a much larger number. And it's a very easy sale because you're not asking for more money today. You're not committing them to anything, but you're showing them a possibility. Usually when I show agents these 2 illustrations, the one they end up showing to the client is the one with the premium increases. So if you want one tip today, that's going to be your star tip that is going to perhaps increase your commissions over the next year by 50%, 75%, this is it. So I would really encourage you to use that and think about that in terms of leaving room for real life. Another consideration when you're looking for retirement planning cases is what death benefit option do you do? You could do increasing death benefit option or level death benefit option. Well, which one should I use and why? Level death benefit option will result in a higher death benefit initially. And that's great, that's fine, no problem with that. Increasing death benefit option will start out with an initially lower death benefit, and gradually the death benefit will grow as premiums grow. Now, the challenge with death benefit options are, if you leave it on increasing death benefit option, the cost of insurance charges as you get into retirement start to become significant. And if you just stay on increasing death benefit option, that's not going to be the most compelling illustration. So if you use increasing death benefit option, I would suggest to then change to level death benefit, typically in the year following your last premium payment. So if you're doing a retirement planning case, which is probably the most popular sales concept in our IUL, I would suggest using increasing death benefit option and then switching to level in the year following the last premium payment. That's going to be more compelling in terms of retirement income. However, a couple things there. Make sure the client understands that this is on them. It's not going to automatically change. So they need to be aware of what the plan is and what you're showing, so there's some element of control that they need to be accountable for. But the other thing that comes into mind here is that may not be the best solution for everybody, because retirement planning is not only about income. Retirement planning is also about death benefit protection during your working years. And I see this a lot as well. We got a client who's got $200, $300, $400 a month they're putting into a retirement planning case. The minimum face amount on increasing death benefit option is like $180,000. And I'm thinking, wow, Seriously, is $180,000 enough death benefit to really cover your needs? Is that enough death benefit coverage during your working years to protect your family and your heirs? Oftentimes that's too low. So you certainly could consider level death benefit option. Now I understand the retirement income may not be quite as high, but remember that retirement income is only part of a retirement planning case. The major part, and the reason we talk about life insurance, is that because this is first and foremost death benefit protection for their heirs. So you need first and foremost to make sure that you're covering the insurance need that they have during their working years. And if you use increasing death benefit option and solve for minimum face, a lot of times that's not enough. So sometimes consider level death benefit option. Make sure you're meeting their need. For most compelling income stream, yes, it's increasing death benefit option. But if you have a situation where, well, I want to use increasing death benefit option, even though it might not be meeting their need, then here's an idea for you and another little illustration tip. Maybe what you have here is a supplemental term insurance sale. So you can certainly use increasing death benefit option and get a supplemental term policy. The nice thing about a supplemental term policy, it covers their need at a reasonable cost. And one more advantage of a supplemental term policy is that if you use term insurance, it can not only cover that need, but it is convertible to an increase on the base illustration. Remember earlier I talked about real life. What happens if, what about real life scenarios where they might want to increase their premium payment? And I said you had to go through underwriting to apply for a face amount increase. If you have a side term policy to protect their need, you can make a term conversion into an existing life insurance policy and essentially overcome that challenge of insurable interest and underwriting in terms of raising the existing policy up, leaving room for more premium. So that's another idea regarding increasing death benefit option with maybe a side term case, because that term provides coverage during their working years and it provides convertibility into the base policy. And one of the other questions I get from people sometimes is, well, which one do I use, guideline premium test or cash value accumulation test? I see both. And sometimes we see people just using CVAT because, oh, it says cash accumulation, that's what I want, right? Well, cash accumulation test is can sometimes be nice in some rare circumstances, but I would say 99% of the time, unless you're looking at a particular sale, which is called our smart money sale on the rapid builder product, that one uses cash value accumulation test very effectively. And because you're already willing to become a MEC, for example. But if you're trying to avoid MEC status, if you're doing a retirement planning case, don't use the cash value accumulation test, use the guideline premium test. The cash value accumulation test seems like it has a great advantage in the sense that it does not have guidelines, and that could be a limiting factor on your funding. But the cash value accumulation test has a disadvantage that goes with it, and that's a higher corridor factor, and that means essentially higher mortality and policy charges. And the higher policy charges impact the performance of the policy. So if you want the best performing retirement income, for example, use the guideline premium test, probably increasing death benefit option. That's going to be your most compelling retirement income planning case. Reserve CVAT for a rare case where guideline doesn't work or for a smart money sale. And if I were to say how many times would I use guideline versus CVAT on a retirement planning case, I would say 99.9% of the time you're going to be using guideline. It should be very rare that CVAT should be used outside of an odd circumstance or in a type of case that is designed for that, like the smart money sale. A couple other tips here. Age on illustrations. We'll talk about loans or withdrawals at the beginning of the year and the duration of the cash value. You know, when I look at age on illustrations, one of the things that I see, especially when kind of comparing on companies' illustrations, is that some products use age nearest and some use age last. In fact, even within North American, we have some products that use age nearest and some products that use age last birthday. So you need to be aware of that and not just type in their age. You may have a client who's currently age 45, but on an age nearest basis, they may be age 46, while on age last, they may be 45. So you need to bear that in mind. For example, our Guarantee Builder uses age nearest birthday, while our Rapid Builder and Builder product use age last birthday. So that's something just to be aware of. Maybe specify their actual birth date rather than their age itself. Another thing to think about is the withdrawals at the beginning of the year. On our illustrations, all of our distributions assume at the beginning of the year. So when you see our age on our illustrations, and now on our iPipeline illustration software, we have the beginning and the end of the year age. Even though the account values are shown at the end of the year on our illustrations, be aware that the distributions are at the beginning of the year. They start right away. So if you're taking a loan or withdrawal, it is assuming the first day of that policy year. So for example, if I'm in a policy year where on the illustration it shows 64/65, and they say, well, at the end of the year I'm 65, so that's when I want to start distributions. Well, remember, loans and withdrawals actually start at the beginning of the year, where the client is age 64. So if you want to have loans or distributions start at age 65, for example, then I would suggest making sure that the beginning of the year age is 65, that the end of the year age is 66, because that is really what they're asking for. And why do I make a big deal about this? It seems very trivial, because it's going to make a difference in the income stream. It's going to show you a different number. And if you illustrate income 1 year earlier than they're really asking for, you're going to be showing a smaller income amount. And you don't want that. You want something that is as compelling as possible. So remember that distributions start at the beginning of the year. Look at the age at the beginning of the policy year to match up with what their goal is. And on a side tip on that same topic, while I'm talking about age, another thing that I see sometimes is people assume that clients always want income at 65. I see that a lot. It's amazing how many times we see illustrations for retirement income and everyone wants income at 65, yet when I look at the actual statistics on when people retire, it's all over the board. Some people retire at 67 or 70, some people retire at 62, yet I see so many illustrations that start the income at 65. Maybe it's an idea that we're kind of making an assumption on the client's behalf that, oh, this is when you want income, right? Instead of asking them, when do you want income to start? So that's something to really be aware of, because if you show income at age 65 and they actually wanted income at maybe at their normal retirement age of 67, then you're going to be showing a smaller amount than you could have shown if you would have waited until the year that they actually wanted to show. So meet the client's needs in terms of when they want to start income. And then last bullet here is consider the duration of the cash value. And I see a lot of times where people will illustrate income in retirement for 20 years. They'll show from 65 to 85, for example, or 25 years, from 65 to 90. See a lot of those illustrations. And that I kind of understand what they're going for. They're saying, well, because that's probably a typical age at which people die, 85 or 90. So that's kind of a general life expectancy. And they use that type of a number to get an estimate. And the thought process is that, well, I can get a larger income stream if I just show illustrating income to age 85 instead of illustrating income to age 100 or 120. And you might be able to get a little bit larger income stream illustrating at 85, but not a lot. It's not a big difference to continue that income to age 120, especially if you're using variable loans with any sort of loan arbitrage in the illustration. I see illustrations where they might show $35,000 a year of income to age 85, but if I do income to age 120, it's maybe $33,000. Well, that's not a lot of difference in income for a huge difference in the duration of income. And even though we say, well, maybe the average life expectancy is 85, but do you want an average of 50-50 chance of outliving your illustrated income? That's not really probably what they're looking for. I think in today's clients, they're looking for a little bit of conservatism. There's a reason why they're with IUL to begin with, because that safety element of the 0% floor in a given year. So, you know, think about, do you really want to stop it at age 55? Don't get into a habit that the clients may not appreciate or might not really be as effective as showing an income stream much longer. And at some point on illustrations with some variable loan arbitrage, there's usually a tipping point that it doesn't help you anyway. For example, age 90. If you see an income stream going to age 90, a lot of times you could have just as well continued that income stream to age 100 or 120 and got the exact same amount anyway. Because with variable loan arbitrage, typically you see the account value drop, and then when you get to a tipping point around age 88, 89, 90, 91, and where it actually starts to go back up again. And if you ever see the illustration where the account value starts to go back up, at that point you should realize that it wouldn't have mattered if I stopped my loan here or not. Once the surrender value starts going back up again, you could have just well continued that income stream beyond to age 120. So really consider, do you need to stop it? Is it just a habit that you have to run to age 85? Really run another illustration to age 100 or 120 and see how it looks. And of course, with North American on our current products where no charges beyond age 100, you're going to see the same amount from age 100 to 120. So if you want, you could just well show it to 120 as well. Now I want to talk a little bit about historical lookbacks and just give you a little flavor for what's going on there, how companies have these lookbacks. Is the rate that I'm illustrating reasonable or prudent? And so just a quick lesson here on historical lookbacks. What companies do is they calculate the geometric average. That's not the simple average, which is when people add up 10 numbers and divide by 10. That's a simple average. A geometric average takes into account the actual range and negatives and positives and timing, and it gives a much more accurate methodology. It's not as simple a formula, but this is the reason sometimes when I see people saying, well, hey, I've added up all the years and I did not come up with the same illustrated rate that you guys did. Well, you probably weren't using a geometric average. But when people do percentage returns, that's the methodology. So we calculate a geometric average for the last 25 years for now versus 25 years ago, and what was the average return. And we do it for every trading day of the year. And so for a North American company, we have daily sweeps. That means we're going to calculate our geometric average for every single trading day of the year. And then we repeat that for all the way back for the last 65 years. And we're going to average all of those together. And that's how we come up with our historical lookbacks, the maximum illustrated rate, is we have a series of 25-year returns over a 65-year period. And all of those data points come up with over 10,000 different numbers, 10,000 different data points together. We average all those together, and that's how we come up with our historical lookback. Now, is the historical lookback an accurate estimate of what's going to happen? No, it's not. It's a historical lookback. It's an accurate representation of what did happen, but not what would have happened. Actually, it's even questionable about what did happen, because historical lookbacks are assuming today's cap and par rates, not what the historical cap and par rates would have been. So cap and par rates may have been higher 5, 10, and although we did not have our products 20 or 30 years ago, they probably would have been higher as bond rates were significantly higher to support higher caps back then. So in some sense, the historical lookbacks, although they use today's cap and par rates with historical index performance, they don't use historical cap and par rates. So in some sense, they're a little bit lower than they might have actually historically been. So that, and a company, and I had a question from Paul, what if a company doesn't use daily sweeps? Do they do their methodology the same way? I believe they do. The NAIC has gathered together regulations as far as how they do this. So I believe they do. Do their calculations the same way. I think they do every trading day of the year, because you don't know when an index. I'm not entirely sure. I know we do every trading day of the year. I think other companies do as well, but I could see where they could justify maybe doing monthly if they only have monthly sweeps. The historical lookbacks are typically updated by March 31st. If the historical lookback is going lower, you're going to need to have them done by March 31st. If the historical lookback goes higher, I suppose it could be a little bit after that. And so we typically see those done by the end of March. And then, of course, or if there's an option or a cap or par rate change. So if we have a par or spread or cap rate change, we'll update historical lookbacks as well. No index selection can illustrate higher than the benchmark, the S&P 500 point to point, even though an index selection might have historically done better. For example, our S&P with spread, our S&P 500 point to point with spread has historical lookbacks significantly higher than the S&P 500 point to point. But one of the AG 49 regulations is that you can't illustrate higher than the benchmark index, which is the S&P 500 point to point. And so even though our uncapped with spread has higher historical lookbacks, it's not illustrating any higher than the S&P point to point. So that's just a little bit of background on lookbacks. In case agents or clients are understanding, want a little bit better information on why this illustrated rate, or if you want a better understanding of why the maximum illustrated rates are what they are, that would be something, a little bit of information there. And the last thing before I go in and open it up for questions is comparing illustrations. Here's a number of things that I think are of interest when you're comparing illustrations, and that means comparing either within our own company, the builder versus the guarantee builder or the rapid builder, or comparing other competitor products. There are interest rates, product pricing, variable loan rates, the issue age, the policy years that you're using. So let's kind of look at a few of these. First is interest rates. I just talked a little bit about historical lookbacks and all of the actuarial guideline AG 49, science into being fair about how all companies do these illustrated rates. And be aware that, and I'm kind of going to allude into this product pricing aspect here as well. Products are different. They're priced different. They may have different policy charges. They have different fees. They have different elements within them that are designed for different things. Some policies may have a % of account value charge that might help support a higher cap. Other policies may not. Even within our own portfolio of our builder, rapid builder, guarantee builder, and our legacy optimizer, I guess, another IUL product, and our survivorship, they all have different caps and par and spread rates because they're priced different. They are different products, and you're going to see the same thing with the competitors. You're going to see other companies' products are different than our own. They have different cap rates because they're designed and priced differently. So what do you do when what illustrated rate do you use? What interest rate should you use? And I would suggest that you really consider using the historical look-back rate. Now, I get it. Some people don't want to they don't want to illustrate the max rate. Okay, that's fine, and I'll get into that in a minute. But if you illustrate the historical look-back rate, you're accommodating for the pricing and design elements of the product. So, for example, our rapid builder has a significantly lower cap rate and illustrated rate than our builder product. I would not illustrate those two products at the same rate. Well, first of all, I can't raise the rate on my rapid builder to match the builder product, but I don't think I should be fair to lower the rate on the builder product either, because it has different charges and fees to help pay for a higher cap rate. And so it's not fair to dial that down artificially just so that I can see two illustrations that look like they're run at the same rate. That's not apples to apples. That's not fair. That's not a reasonable comparison. The products were not designed to run at those rates. And the same thing with the competitors. I see illustrations sometimes where someone will say, hey, run this at 6.71. And I'm going, well, why? Where did that number come from? Certainly the client didn't just arbitrarily tell the agent, oh, by the way, run this at 6.71. No, it's because there's maybe a competitor product that's the maximum rate they can illustrate. Well, it would probably be most fair to illustrate at the same historical look-back rates, even though the rates are different. I know it seems like you want to be fair by dialing it to the same rate. That's not right. Now, I said I'd go back to the idea of, well, what if you don't want to illustrate at the max historical look back rate? What if I don't want to illustrate over 7%? That's fine. Then go ahead and dial it down. Maybe you guys say, I don't want to illustrate anyone over 6.5. Okay, we'll dial ours down by 61 basis points to 6.5. Then dial the other illustration down by 61 basis points as well. That's the most comparable illustration, not trying to artificially match the numbers, the illustrated rate, and ignoring, because I can't take policy charges off of our product in order to compare with another company's illustrated rate. So that's what I would suggest about illustrated rates. It is really the most reasonable and fair way to do it. How about variable loan rates? When you're looking at variable loan rates, one of the things that is going to make because this is about illustration tips and hints and ways to make your illustrations as compelling as possible, use variable loans to make the most impressive illustrated income stream. For a retirement income, for example, variable loans are going to perform or show a better illustration than standard loans or net cost zero loans or withdrawals to basis. Variable loans will do the best. Now, in terms of what rate should you use, our current variable loan rate is 4%. So you think, well, I should probably use 4%. Well, not necessarily. What's an interesting thing here is that a variable loan is going to show, is going to illustrate best when you get to as close to the 1% limit that the AG 49 regulations have, where illustration software cannot show any more arbitrage. And arbitrage is the difference between the rate that they're credited and the rate they're charged. The rate that we're showing, assuming that they're getting on their index performance, and the rate we're charging them on their variable loans. That's if it's positive, where they're getting more than they're being charged, that's arbitrage, positive arbitrage. And the most we can illustrate is 1% positive arbitrage, even though in real life they could get significantly more or less than that. The most we can illustrate is 1% positive arbitrage. So you want that variable loan rate to be as close to that 1% as you can. So if I'm illustrating an index life illustration at 7%, the most compelling illustration with the best income stream is going to be a variable loan at 6%, not 4%. And I know you're thinking, well, why not 4%? Well, you're going to get a little bit more arbitrage as the loan gets larger. The larger the loan size, the more arbitrage you get. And a 6% loan will illustrate a larger loan size and arbitrage than a 4% loan. And if you want, don't believe me, try them both. You can see the difference. Now, in real life, of course, the client would rather have the 4% loan and get a 3% arbitrage rather than 1. But we can't illustrate any more than 1. And so for illustration purposes, you want that variable loan rate to around 1%. So if I'm dialing the illustration down to 6.5, what's going to give me the strongest illustration income stream is showing the variable loan at 5.5, 1% less. And again, going back to the idea of issue age, if you're running an illustration and looking at another product, whether it's within our company or a competitor, be aware of the birth date, because sometimes a competitor may be age nearest, we're age last. A client may be age 48 with the competitor product, which is age nearest, but with North American's Builder Plus, they might be 47, 1 year younger, so to speak. So be aware that of their actual birth date and put that in, because 50% of the time, I guess, they would be 1 year younger on age last birthday product instead of an age nearest. And if you just throw in their age, you're misstating it by 50% of the time. That's a big deal. And then match policy years for premiums and disbursements. Sometimes we see clients or policies with a competitor, they might use age at the beginning of the year on their illustration output. They might use the age at the end of the year on their illustration output. Our products now, with our illustration on iPipeline, we show both ages, so that helps, that you can match them up. But be aware of what age they're showing, because you want to make sure that they match up. And probably the best thing to help you in that regard is ignore the age, match the years. So if they're paying for 18 years and you want to compare it to North American, show 18 years. Don't try to match up the age, match up the policy year. And if they're showing the distribution starting at, year 35, match up year 35. Don't try to match up the age in that regard, because you don't want to misstate or misrepresent either one of the two products. That would be the best way to make sure that you're comparing illustrations accurately. And then other features and elements that we have. Don't forget, there's a lot more to just performance. A lot of it is the company and the design of the product. And some of the things I already mentioned, the daily index sweeps, which is certainly a nice talking point. You don't have to have money sitting in the fixed account for 3, 4 weeks. Actually, with some of these companies, even with monthly sweeps, if you're not in there 5 days ahead of time, you missed your sweep. So it could be, longer than even 4 weeks sitting in the fixed account, earning very little. So the nice thing about the daily sweeps is the funds can start an index segment right away, and it just seems to make more sense. It's easier to explain. Index credits are on the beginning of the segment value, not the end of the year segment value or some average amount. That's a really nice design element that if you get into somebody who wants to understand more, and maybe you don't bring this up to the client, but you yourself should be aware of this, that we credit interest on the full beginning of the segment value, not the end of the year value. So for example, if the segment is $1,000 at the start of the year and the index grows 10%, we're going to credit interest on the full $1,000 that the index segment was at the start of the year, not the $800 that it was at the end of the year after policy charges. There's a difference between crediting 10% on 1,000 or crediting 10% on the ending value after policy charges 800. And you compile that and compound it over a period of 30, 40 years, there's going to be a difference in policy performance there. No funds required in the fixed account. That's a nice deal. Interest rate bonus. Remember, our interest rate bonus is contractually guaranteed on the indexed account. It's conditionally guaranteed on the fixed account, but contractually guaranteed interest rate bonus on the indexed account. That's a nice thing. And the 2.5% minimum account value. That there's some element of return that they're going to get at least on policy termination or the true-up period of 10 years. And then, of course, the company. A+ ratings by AM Best and S&P. Strong company, a company I think that I hope you enjoy working with, and you can share that pride and enthusiasm with your customers. So in summary, we talked a little bit about illustrations, a few little design tips and ideas on illustrations, ways to make them more compelling. We talked a little bit about historical lookbacks and why the illustrated rates are what they are, and comparing illustrations and some more ideas in that regard. The bottom line here is the client's going to get well-designed illustrations, understanding of the historical performance, and a true comparison. If you're comparing other companies' products, you get competitive products that can help meet the client's needs and a company of strength and stability. So what I'm hoping is that you'll go out and find 3 clients. And then next week we're going to talk about sales concepts. If you've already got sales concepts in mind, then I think we've given you what you're looking for. In terms of you're ready to go out there and talk to clients and start setting up appointments right away. If you need to hit our next session next week on sales concepts, then great, we can give you more information on that as well. But really what you want to do is take this newfound knowledge that you've gained over this series and put it to use and start actually getting out there and scheduling appointments. With that, I'll thank everyone who's been viewing the recorded session.